There is a question in personal finance that looks simple until you really study it. Should I pay off my mortgage early or should I invest the money instead? Most people want one clean answer: pay it off. Invest it, never pay off cheap debt. Always get rid of debt. But the real answer is not that simple, because this is not only a math problem, it is a risk problem, it is a timing problem, it is a liquidity problem, it is a behavioral problem. And for many people, it is also a peace of mind problem. That is why this question creates such strong emotions. A mortgage is not like a small credit card balance. It is usually the largest debt a household will ever carry. It is attached to the place where you live. It appears every month. It shapes your retirement plan. It determines how much fixed expense you carry into the future. So when people debate whether to pay it off or invest, they are not really debating only interest rates. They are debating control. They are debating freedom. They are debating risk. They are debating what kind of financial life they want to live. The first principle is this: when you pay off a mortgage, you earn a return equal to the mortgage rate you no longer have to pay. If your mortgage rate is 3%, paying it down gives you something like a 3% guaranteed return. If your mortgage rate is 6.5%, paying it down gives you something like a 6.5% guaranteed return. That is the clean math. Investing is different. Investing may produce a higher return over time, but it is uncertain. The stock market does not give you a smooth 7% or 10% every year. It gives you good years, bad years, crashes, recoveries, long stretches of discomfort, and sometimes returns that arrive only after you were tested emotionally. So the real question is not, which number is bigger on paper? The real question is this: is my mortgage rate higher or lower than what I can reasonably expect to earn after taxes, after volatility, after behavioral risk, and over my actual time horizon? That is the proper comparison. Once you look at it that way, the decision becomes much clearer. There are three zones. The first zone is the keep. The mortgage zone. This is usually when your mortgage rate is somewhere between 0 and 4%. In that range, the math tends to favor investing. Historically, stocks have returned somewhere around 7 to 10% over long periods, depending on the period and how you measure it. Even more conservative portfolios have often returned somewhere around 5 to 7%. So if you have a 2.5%, 3%, or 4% mortgage, the gap between what you pay on the debt and what you may earn by investing is meaningful. That gap is the reason many planners say not to rush to pay off a very low-rate mortgage. But there is another force that people often forget: inflation. Inflation quietly works in favor of the borrower when the loan is fixed. If your mortgage rate is 3% and inflation averages around 2 to 3% over time, the real cost of the borrowing may be closer to 0 to 1%. That is important. The mortgage payment stays fixed, but wages, prices, and nominal incomes may rise over time. The dollar you use to make that mortgage payment in year 20 is usually less valuable than the dollar you used in year 1. So a low fixed rate mortgage can become cheaper in real terms over time. This is why a 3% fixed mortgage is not the same thing as a 3% credit card balance or a 3% short-term business loan. It is long-term fixed debt tied to an asset and paid back in future dollars. When inflation exists, those future dollars may be worth less. That means cheap fixed debt can be an asset like liability. It is still debt. It still creates a payment. But if the rate is low enough, and if you have liquidity, discipline, and a long time horizon, it may not be the debt you should attack first. This is why someone with a 3% mortgage should be careful before sending every extra dollar to the lender. Those dollars may be more productive in retirement accounts, broad index funds, emergency reserves, or other long-term assets. The second zone is the gray zone. This is usually around 4 to 6%. This is where the math becomes less decisive. At 4%, investing still often looks attractive, especially for a young person with decades ahead. At 6%, paying off the mortgage begins to look much more compelling, especially after taxes and risk. In the middle, the answer depends heavily on the person. Taxes matter more. Volatility matters more. Behavior matters more. The account type matters. Your stage of life matters. Your liquidity matters. Your risk tolerance matters. Your retirement timeline matters. This is why competent planners do not usually give a one-word answer in the gray zone. They ask questions. If your mortgage is 5.5% and your after-tax investment return may be 5.5 to 6%, then the spread is very small. At that point, you are not being paid much for taking market risk. The return difference may exist, but it is not a free lunch. It is a risk premium, and every person must decide whether that risk premium is worth it. The third zone is the pay it off zone. This is usually when your mortgage rate is around 6% or higher. At that level, paying down the mortgage becomes very attractive because the return is guaranteed. A 6% market return is not the same thing as a 6% guaranteed return. The market can give you a 20% year, then a negative 18% year, then a flat year, then a recovery. The mortgage payoff is different. Every extra dollar applied to principal eliminates interest that would have been owed. It reduces a fixed liability. It improves the durability of the household balance sheet that does not always produce the maximum upside, but it produces resilience. And resilience matters. If you are paying 6.5% on a mortgage, then every extra dollar paid down earns you the equivalent of a 6.5% guaranteed return before considering certain tax complications or deductions. A guaranteed return at that level is hard to replicate safely elsewhere. That is why the decision flips as the mortgage rate rises at low rates. The decision is mostly about maximizing long-term growth at higher rates. The decision becomes more about protecting the plan that is the key shift: growth versus resilience. Optionality versus control, upside versus certainty. Now, comparing mortgage rates to market returns is useful, but it is incomplete. To make the decision properly, you have to adjust for three things: taxes, risk, and time. Start with taxes. People often say the market returns 7% after inflation, or 10% before inflation, depending on the data they are using. But that does not necessarily mean you keep all of that return. In a taxable account, you may pay taxes on dividends, you may pay taxes on capital gains, you may have turnover inside funds, you may have state taxes. You may not actually keep the headline return. A 7% return may become 5 to 6% after tax for some investors. The exact number depends on the tax bracket, the state, the account type, and the investment structure. Index funds and ETFs can be more tax efficient because they often have low turnover and more qualified dividends that can help. Instead of losing a large portion of return to taxes, you may keep more of it. But the tax drag is still real in taxable accounts. If you are investing through a Roth IRA, Roth 401k, traditional IRA, traditional 401k, or another tax-advantaged account, the comparison changes in those accounts. Capital gains and dividends are generally not taxed each year. The money grows tax-free or tax-deferred depending on the account type. In that case, the investment return is not being reduced by current taxable events in the same way. So the account type matters. A 3% mortgage versus a tax-advantaged investment account is usually a very different comparison from a 5.5% mortgage versus a taxable account. This is why you cannot answer the question in isolation. You must know where the money would actually go. If the extra money would go into a Roth IRA or a workplace retirement account and grow tax advantage for decades, investing may be more attractive. If the extra money would go into a taxable account and the mortgage rate is high, paying down the mortgage may be more attractive. Taxes change the spread, and when the spread is small, small changes matter. The second adjustment is risk. Paying off debt is certain, investing is not. That is one of the most important distinctions in the whole discussion. If you pay down a 6% mortgage, the interest avoided is locked in. If you invest expecting 7%, that return is uncertain. Historically, markets have rewarded patient investors. But the path is never smooth. There are recessions, bear markets, crashes, inflation shocks, banking problems, political shocks, wars, and long periods where returns are disappointing. This matters especially near retirement because of sequence of returns risk. Sequence risk means that the order of returns matters. If you are young and still investing, a market crash can be unpleasant but manageable. You can keep working, you can keep buying. You can recover with time, but if you are retired or close to retirement and a major market downturn occurs while you are withdrawing money, the damage can be much more serious. You may have to sell assets when prices are low in order to pay bills. If you also have a mortgage payment, your required withdrawals are higher. Higher withdrawals during market weakness can permanently damage a retirement portfolio. This is why paying off a mortgage before or during retirement can make sense, even if the spreadsheet says investing might produce a slightly higher expected return. Lower fixed expenses reduce fragility. They reduce the amount your portfolio must provide. They reduce sequence risk. They increase the chance that your plan survives bad market timing. This is resilience. And in retirement, resilience can matter more than maximum expected return. The third adjustment is time horizon. If you are 25 or 30 years from retirement, investing tends to win more often because time helps absorb volatility. Over very long periods, broad stock markets have historically had a very high probability of positive returns. Compounding has time to work. Bad years can be followed by recovery years. Contributions can continue through downturns. Time is a risk absorber. It does not eliminate risk, but it changes the shape of risk. If you are young, every dollar invested can compound for decades. That is incredibly powerful. A dollar invested at age 35 and earning 7% over 30 years becomes about $7.61. A dollar invested at age 45 and earning 7% over 20 years becomes about $3.87. That difference is enormous. The same dollar, the same return, different time. This is why younger people should be careful about overpaying a mortgage if it prevents them from investing for many years. They may be sacrificing the most powerful compounding years of their lives. But as you move closer to retirement, the equation changes. You no longer have the same recovery window. The value of reducing fixed expenses rises. The value of certainty rises. The cost of being wrong rises. At 45, 55, or 65, the mortgage is not just a low or high interest rate. It is a monthly obligation that your future income or portfolio must support. This is why stage of life matters. The same mortgage rate can produce different decisions for different people. A 6.5% mortgage at age 35 may call for a mixed strategy leaning toward investing. A 6.5% mortgage at age 45 may call for a more balanced strategy. A 6.5% mortgage at age 60 may call for strong consideration of payoff, especially if retirement is near. The debt is the same. The context is different. Context changes the decision. Now step back and think about the two paths. Path one is keeping the mortgage. This path focuses on growth and optionality. It tends to make sense when your rate is low, especially in the 2 to 4% range. It also makes sense when you have strong liquidity, good cash reserves, a long time horizon, stable income, and emotional comfort with market volatility. In that situation, the mortgage is relatively cheap. Keeping it allows your capital to work elsewhere. You keep flexibility, you keep investment liquidity, you preserve compounding, you allow inflation to erode the real burden of the mortgage over time. That is the growth. Optimized path. Path two is paying it off. This path focuses on stability and control. It tends to make sense when the rate is closer to 5-6% or higher, when you are near retirement, when fixed expenses feel tight, when you are already drawing from your portfolio, or when the mortgage creates emotional or financial fragility. In that situation, the mortgage is not just debt, it is a fixed claim on your future income. Removing it can make the entire plan more durable. You may not maximize every dollar of expected return, but you reduce the chance that the plan fails under stress. That is the resilience. Optimized path. Now the better question is not always, is my rate lower than market returns? Sometimes the better question is this: does this debt make my plan more fragile? That is a deeper question. A 3% mortgage may be cheap, but if the monthly payment is large relative to your retirement income, it can still make your plan fragile. A 5% mortgage may not be mathematically terrible, but if it forces high withdrawals from a portfolio during a market downturn, it can become dangerous. A mortgage is a fixed expense. Fixed expenses reduce flexibility. The more fixed expenses you carry, the more your life depends on stable income and stable markets. That is why many retirees feel great relief when the mortgage is gone. It is not because the spreadsheet always says payoff was optimal. It is because the household became less fragile. And very few people regret having fixed expenses that are too low. That is worth remembering. Now, the gray zone deserves special attention because that is where most real decisions live. In the gray zone, you do not have to choose all one side. You can use a hybrid strategy. You can invest part of the extra money and apply part of it to the mortgage. This reduces regret. It balances math and psychology. It preserves flexibility. It captures some market upside while also reducing the debt. That can be a very wise approach. Many financial arguments become less useful because people frame them as all or nothing decisions, all investing, all mortgage payoff. But in real life, many good decisions are blended. If your rate is around 5% or 6% and you have extra cash flow, you may divide it. Some toward retirement accounts, some toward the mortgage, some toward liquidity. If cash reserves are not strong, that way if the market performs well, you participate. If the market performs poorly, you still made progress on guaranteed debt reduction. If interest rates remain high, you reduce the liability. If your emotions value debt freedom, you move in that direction. This is not mathematically pure. It is behaviorally robust, and behavior matters because the best spreadsheet plan is worthless if the person cannot stick with it. Now, let us run through the example from the source. Imagine a $400,000 mortgage, 30-year fixed, 6.5% interest rate. That rate is high enough that the decision is not obvious. especially because age changes everything. Case 1 is a 35-year-old borrower. At 35, time is extremely valuable. This person may be 25 or 30 years from retirement. They are likely entering peak earning years. They still have a long compounding runway. They can recover from market volatility. If this borrower pays down a 6.5% mortgage, they earn a 6.5% guaranteed return. That is meaningful. But if they invest over the long term, the market may return 7 to 10% in a broad stock portfolio or 5 to 7% in a more conservative portfolio. The spread is not large, but time matters. A dollar invested at 35 can work for decades. So for this person, I would generally lean toward investing while not ignoring the mortgage. Maybe the extra dollars are split 80% to investing and 20% to the mortgage. This protects the compounding engine while still capturing some guaranteed debt reduction. The mistake for a 35-year-old may be going all in on the mortgage if that means not investing for several years. Those early investment years are too valuable to casually give away. The person may feel safer, but they may have sacrificed a major amount of future compounding. That is the trade-off. Case 2 is a 45-year-old borrower. Now the time horizon is shorter, retirement is closer. The portfolio should already be larger. A market downturn matters more. Sequence risk is becoming more relevant. Fixed expenses in retirement matter more. For this person, a more balanced strategy may be appropriate. Maybe 60% of extra dollars go toward investing and 40% toward the mortgage. Maybe it becomes 50 divided by 50. The exact split depends on the whole plan. But the direction is clear at 45. You still need growth, but you also need to reduce future fragility. Ignoring a large 6.5% mortgage at age 45 could be a mistake if it leaves you with a large fixed expense as retirement approaches. That mortgage could increase required withdrawals. It could increase sequence risk. It could reduce flexibility when flexibility matters most. So the 45-year-old should take the mortgage more seriously than the 35-year-old, same rate. Different stage, different decision. Now let us look deeper at the math of the $400,000 mortgage at 6.5%. The monthly payment is roughly $2,500. Over 30 years, the borrower pays around $910,000 total. The total interest paid is over $500,000. That is a lot of money. So it is completely understandable that someone sees those numbers and wants to attack the mortgage aggressively. Paying extra early is especially powerful because the balance is highest early in the loan. If you add $500 per month for the first 10 years only, the mortgage may be paid off roughly 6 to 7 years early. The total interest may drop to around $380,000 to $400,000. That saves more than $100,000 in interest. That is real. That is not emotional. That is mathematics. But now compare the opportunity cost. What if that same $500 per month was invested instead from age 35 to 45? If it earned 7% after 10 years, it could be worth around $86,000. If that $86,000 then sat invested for another 20 years without additional contributions, by age 65, it could become around $330,000. So the mortgage prepayment saves around $120,000 in interest and gets the mortgage paid off earlier. The investing strategy may create around $330,000 of wealth, but the $330,000 is not guaranteed. The mortgage interest savings is guaranteed. That is the trade-off in one sentence. Paying the mortgage reduces a fixed expense with certainty. Investing builds a variable asset with uncertainty. Both can be rational. The better choice depends on the person. The data tells you the structure. Your life tells you the priority. Now, I want to explain the emotional part carefully because many financially sophisticated people dismiss it too quickly. Peace of mind is real. You cannot put it perfectly into a spreadsheet, but that does not mean it has no value. If paying off your mortgage allows you to sleep, retire with confidence, take less portfolio risk, change careers, or feel that your family is secure, that may be worth more than a higher expected return. Money is not only about maximizing the ending number. It is about building a life that works. A person who invests instead of paying down the mortgage but spends 20 years anxious may not have made the best decision for their life, even if the expected return was higher. At the same time, peace of mind can become expensive if it leads someone to overpay low-rate debt while ignoring better uses of capital. So you must be honest. Are you paying down the mortgage because it truly strengthens your plan, or are you doing it because you are afraid of volatility and do not understand investing? Those are different reasons. Fear without understanding can lead to suboptimal decisions, but a conscious preference for control can be rational. The difference is awareness. Now, if your mortgage is below 4%, the case for investing is usually strong, especially if you are young, have liquidity, and can use tax-advantaged accounts. The mortgage is cheap. Inflation may reduce the real cost. Market returns have historically been higher. Paying extra on the mortgage may feel good, but it may not be the best use of capital if your mortgage is above 6%. The case for payoff is much stronger, especially as you approach retirement. The guaranteed return is meaningful. The mortgage creates a significant fixed expense. The after-tax investment spread may not be large enough to justify the risk. If your mortgage is between 4 and 6%, the answer is personal. Your age, liquidity, taxes, risk tolerance, retirement timeline, portfolio size, and emotional relationship with debt matter more. This is where the hybrid strategy often shines. It lets you move forward on both goals. Now, there is another important principle before making extra mortgage payments or investing aggressively. Make sure the rest of the financial foundation is healthy. Do you have an emergency fund? Are you carrying high-interest credit card debt? Are you getting your employer retirement match? Are you properly insured? Do you have enough liquidity for repairs, job loss, medical costs, or unexpected expenses? A mortgage payoff decision should not be made in isolation. If you send all extra cash to the mortgage and have no emergency fund, you may become house rich and cash poor. That is dangerous. Home equity is not the same as liquidity. If your roof fails, the bank does not automatically turn your extra principal payments back into cash. You may need a home equity line, refinancing, or selling the property, and those options may not be available on good terms during stress. Liquidity matters, so before aggressively prepaying a mortgage, keep cash reserves. That is another reason a hybrid strategy can work. Some money to investing, some money to mortgage, some money to liquidity if needed. A strong balance sheet is not just debt-free, it is resilient. Now, let us think about the person who is in retirement or near retirement. For them, the mortgage decision is not just about rate arbitrage, it is about withdrawal rate. If you need $60,000 per year to live without a mortgage and $90,000 per year with a mortgage, your portfolio has to support a much larger withdrawal. That difference can determine whether the plan survives. A lower required withdrawal rate is one of the most powerful ways to make retirement more durable. If paying off the mortgage reduces the required withdrawal rate, it may be worth doing even if the mortgage rate is not extremely high. This is where math and risk converge. The mortgage payment is not only an interest rate, it is a monthly demand on the portfolio in retirement. Fixed expenses are more dangerous because the portfolio may be volatile. If the market falls and you must still withdraw large amounts to make mortgage payments, the portfolio can be damaged. This is why debt-free retirement can be powerful, not because it maximizes every dollar in every scenario, because it lowers the amount the portfolio must produce. That improves the durability of the whole plan. Now, the younger person has a different problem. The younger person's greatest asset is time. If they use all their extra dollars to pay down a mortgage and neglect investing, they may reduce debt but miss years of compounding. That can be a major mistake. A 35-year-old with a 6.5% mortgage may still need to invest because 30 years of compounding is extremely valuable. The mortgage rate matters, but time also matters. This is why a 35-year-old and a 55-year-old should not automatically make the same decision. A strategy is only good if it fits the stage of life. Now, there is a very common mistake in this debate. People compare guaranteed debt payoff to average market returns as if they are identical kinds of returns. They are not. A mortgage payoff return is certain. A market return is expected. Expected return includes risk. If the expected market return is 7% and the mortgage is 6.5%, the spread is only 0.5% before taxes and risk adjustments. That is not much compensation for uncertainty. If the mortgage is 3% and expected investment return is 7%, the spread is 4%, that is much more meaningful. The size of the spread matters. When the spread is wide, the decision leans toward investing. When the spread is narrow, the decision leans toward certainty or a hybrid approach that is a useful mental model. Now, taxes can shift the spread if your mortgage interest is deductible and you actually itemize deductions. The after-tax cost of the mortgage may be lower, but many people do not benefit as much from the mortgage interest deduction as they assume, especially if they take the standard deduction. So do not rely on tax myths. Look at your actual tax return. Does the mortgage interest deduction really reduce your tax bill? If yes, by how much? What is the after-tax cost of your mortgage? What is the after-tax return of the investment alternative? Those are the real numbers. Similarly, if you invest in taxable accounts, your after-tax return may be lower than the headline market return. If you invest in tax-advantaged accounts, your return may face less annual drag. Again, the structure matters. Now, risk tolerance is not only what you say in a calm room, risk tolerance is what you actually do when the market falls. Many people say they are comfortable with volatility until their portfolio drops 25%. Then they sell. If you invest instead of paying off the mortgage, but you sell the investments in a panic during a downturn, the strategy fails. The spreadsheet assumed you stayed invested. If your behavior cannot support the strategy is not suitable. This is why paying down the mortgage may be better for some people, even when investing has higher expected returns. A lower expected return that you actually capture can be better than a higher expected return that you abandon under stress. Behavior is part of the equation. That is why this question cannot be solved by math alone. Now, I want to frame the mortgage as a liability in a larger system. A household balance sheet has assets and liabilities. Investments are assets, cash is an asset, home equity is an asset, the mortgage is a liability. When you invest extra cash, you increase assets. When you pay down the mortgage, you reduce liabilities, both increase net worth, but they affect the balance sheet differently. Investments are liquid and volatile. Mortgage payoff is illiquid and stable. Investments can produce higher long-term returns. Mortgage payoff reduces fixed obligations. Investments can be sold if needed. Mortgage payoff may require borrowing or selling the house to access. Investments can fall in value. Mortgage debt reduction does not reverse unless you borrow again. So the choice is not simply return versus return. It is balance sheet structure. Do you need more liquid assets? Do you need less fixed debt? Do you need more growth? Do you need more control? Do you need more retirement security? That is the true decision. Now let us return to the hybrid strategy in practical terms. Suppose you have $1,000 per month of extra cash flow. If you have a low-rate mortgage and you are young, maybe $900 goes to investing and $100 to the mortgage, or perhaps all of it goes to investing after you have enough liquidity. If you are in the gray zone, maybe $600 goes to investing and $400 to the mortgage. If you are closer to retirement with a higher rate, maybe $300 goes to investing and $700 to the mortgage. These are not universal rules. They are examples of matching the split to the life stage and rate environment. The important idea is that the split can change over time. When you are younger, invest more as retirement approaches. Reduce fixed obligations more. If markets fall and valuations become attractive, you may lean more into investing. If your mortgage rate is very high, you may lean more into payoff. If your liquidity is weak, you build cash first. A good plan adapts. It does not follow a slogan forever. Now, some people say, I want the house paid off because then no one can take it from me. That feeling is understandable, but it is not perfectly accurate. Even without a mortgage, you still have property taxes, insurance, maintenance, and other obligations. If property taxes are not paid, the home can still be at risk. A paid-off home is powerful, but it is not cost-free. You still need cash flow, so do not pay off the home in a way that leaves you unable to maintain it. Again, liquidity matters. Others say debt is always bad. That is too simple. Debt can be dangerous. Debt can also be useful if it is fixed, low cost, attached to an appreciating asset, and held by a borrower with strong liquidity and discipline. A 3% fixed mortgage is not the same as a 22% credit card balance. The type of debt matters, the rate matters. The purpose matters, the borrower matters, the time horizon matters, the full system matters. Now, some people say, the market always beats the mortgage. That is also too simple. The market has historically beaten low mortgage rates over long periods, but not every period, not every investor, and not every tax situation. The market does not guarantee returns exactly when you need them. If you retire into a bad sequence, the average return over 30 years may not protect you from early withdrawal damage. So the market can be the better long-term tool and still not be the right answer for every dollar. This is why good finance is rarely about absolutes. It is about trade-offs. The trade-off here is growth versus certainty, liquidity versus debt reduction, expected return versus guaranteed return, compounding versus control spreadsheet, optimization versus psychological peace. A strong plan respects all of those. Now, there is one more factor. What would you actually do with the money if you did not pay down the mortgage? This matters. The comparison is only valid if the alternative is real investing. If you say you will invest instead, but you actually spend the extra money, then investing did not win. Spending won. Many people use the argument for investing as an excuse not to pay down debt, but then the money disappears into lifestyle. That is the worst outcome if you choose to invest instead of paying down the mortgage. Automate the investment. Make sure the dollars actually go into the portfolio, otherwise the theoretical math is meaningless. The mortgage payoff has one behavioral advantage. It forces the money into net worth. Once you send it to principal, it is less likely to be spent. Investing can be just as good or better if it actually happens, but if it does not happen, the whole argument collapses. Behavior again. Now, what is the overall framework below 4%? Lean toward keeping the mortgage and investing, assuming you have liquidity, time, and discipline. Between 4 and 6%, consider a hybrid strategy and let taxes, risk tolerance, age, liquidity, and retirement timeline guide the split above 6%. The case for paying down the mortgage becomes much stronger, especially as you move toward retirement, but do not use those zones mechanically. They are starting points. Your personal situation decides the final answer. If you are 35, a 6.5% mortgage may justify investing plus some extra payoff. If you are 45, the same mortgage may justify a more balanced or payoff heavy approach. If you are 60, the same mortgage may be a major retirement fragility problem. Age changes the answer. Income changes the answer. Portfolio size changes the answer. Liquidity changes the answer. Taxes change the answer. Risk tolerance changes the answer. Now, I want to describe the emotional clarity of being mortgage. When the mortgage is gone, the household cash flow changes. The largest fixed payment disappears. The income needed to survive falls. The pressure on the portfolio falls. The psychological weight falls. For some people, that is worth a great deal. A home without a mortgage can feel like a fortress. But the fortress still needs supplies. You still need investments. You still need cash. You still need insurance. You still need tax planning. You still need to maintain the property. A paid-off house is not a complete financial plan. It is one strong piece of a plan. Similarly, a large investment portfolio with a low-rate mortgage can be a strong plan if the investor has discipline and liquidity. There is more than one good answer. The goal is not to win an argument. The goal is to build a financial life that works. Now, if I had to express the decision in one sentence, I would say this. When the mortgage is cheap and time is long, invest more. When the mortgage is expensive and retirement is closer, pay it down more. When the answer is unclear, split the difference intelligently. That is the practical framework. But the deeper principle is this. Do not optimize for one variable while ignoring the system. Interest rate is one variable, taxes are another, time horizon is another, risk is another, liquidity is another, behavior is another, peace of mind is another. The best decision is the one that strengthens the whole system. Sometimes that is investing, sometimes that is paying down the mortgage, sometimes that is both. Now consider the person who insists they will earn more in the stock market. They may be right, but they must accept volatility, they must stay invested during drawdowns, they must not panic sell, they must have emergency cash, they must actually invest the money. They must accept that returns may come later than expected. If they can do that, investing can be powerful. Consider the person who insists they want the mortgage gone. They may be right too, but they must understand opportunity cost. They must not leave retirement accounts unfunded for years. They must not become house rich and cash poor. They must not assume a paid-off house solves all retirement issues. They must preserve liquidity. If they can do that, payoff can be powerful. This is why I do not like one size fits all answers. They produce false confidence. A person with a 3% mortgage and 30 years to invest should probably not make the same decision as a person with a 6.5% mortgage in retirement. In 5 years, the numbers may look related, the lives are different, finance is personal because constraints are personal. Now, the final part of this discussion is about peace of mind. The data can guide the decision. It can show probabilities. It can show historical outcomes, it can show interest saved, it can show projected investment growth, it can show tax effects, it can show time horizon, but it cannot fully quantify what it feels like to carry debt. For some people, debt is a tool. For others, debt is a burden. Neither person is automatically wrong. The only mistake is pretending that your emotional structure does not matter. If carrying a mortgage causes constant anxiety and paying it down would make you more stable and more disciplined. That matters. If paying off the mortgage would make you feel safe but would also cause you to neglect investing for decades, that also matters. Good decisions balance math and human nature. The right plan is the plan you can actually follow. If a mathematically perfect plan causes you to panic, abandon it, or lose sleep, it may not be perfect for you. If a peace of mind plan destroys long-term growth and leaves you illiquid, it may not be as safe as it feels. Balance. That is the answer. So, if you have a mortgage and extra cash flow, do not start with ideology. Start with your rate, then your taxes, then your account type, then your time horizon, then your liquidity, then your retirement plan, then your temperament, then decide if the rate is low. The case for investing is strong. If the rate is high, the case for payoff is strong. If you are in the middle, use a hybrid plan. And if peace of mind is the decisive factor, honor it, but do so with awareness of the trade-offs. The objective is not to impress someone with the highest theoretical net worth. The objective is to become secure, confident, and in control. That is what the mortgage decision is really about. Not the mortgage in isolation, your whole financial life.